Welcome to our complete guide on South Korea's tax residency. Understanding the tax residency rules in South Korea is essential for anyone considering a move to this vibrant country, whether you're an expatriate on assignment, a digital nomad, or an international professional. South Korea has a distinctive tax system that differentiates between residents and non-residents. This distinction is crucial as it profoundly influences your tax responsibilities, available deductions, and overall tax burden. In today's video, we'll dive into the requirements, benefits, and more to help you navigate establishing your tax residency in South Korea. One of the most critical aspects of determining your tax residency is the 183-day rule. According to South Korean tax law, you are regarded as a tax resident if you are physically present in South Korea for 183 days or more during a calendar year. This rule is fundamental because it serves as a primary threshold for deciding on your tax status. Importantly, your counting includes both the arrival and departure days and can consist of non-consecutive days throughout the year. If you manage residences in multiple countries, maintaining precise records of your days in South Korea is vital to clarify your residency status while avoiding potential disputes with tax authorities. Another key concept to understand is the idea of domicile or habitual residence. This refers to the primary location where you have established your living base, influenced by personal or economic connections. Even if you haven't met the 183-day mark, you may still hold tax residency if your domicile is established based on various connecting factors, such as family ties, property ownership, and employment relationships. South Korean tax authorities consider these various elements when assessing your residency, emphasizing the importance of understanding both the day count and domicile connections. Once you are recognized as a tax resident in South Korea, you will be liable for worldwide income taxation. This means that all income you receive, regardless of where it's derived, will be subject to South Korean taxes. In contrast, non-residents are taxed only on income generated within South Korea. This includes salary, investments, and rental income. It's important to grasp this distinction when planning your finances, especially as South Korea employs a progressive income tax system with rates that range from 6% to 45%, plus an additional local income tax corresponding to 10% of the national income taxes paid, further increasing your overall taxation burden. Finally, let's discuss the process of obtaining a South Korea tax residency certificate, which is crucial for individuals needing to demonstrate their tax status for international matters, such as double taxation agreements. To apply, you submit necessary documents to the National Tax Service, and typically, this process takes 1 to 2 weeks. Key benefits of acquiring this certificate include access to double taxation agreements with over 90 countries, which help avoid being taxed on the same income in multiple jurisdictions. This can be particularly advantageous for those with income from various international sources, making it essential to understand the specifics of these treaties.